Hello guys, we are in week 3 of our BUS 603 MBA accounting class. So congratulations on all the progress we're making. Um, this week we're covering the income statement and everything that comes with it. Okay, so the income statement covers a period of time. Okay, so from point A to point B, sometimes it's a whole year, sometimes it's a quarter, sometimes it's a month. But it looks at, during that time, all the revenues, money coming in, um, all the expenses, and then after that we've got then net income. Okay, and then from net income we can decide what to do if there's a gain with that money. We can pay out money in dividends to shareholders. We can there's a host of other things that we can do, and those are good things to have because that means we've made money. Okay, so I'm looking at your week 3 income statement assignment. So if you want to have it with you, go ahead and pause the video, grab it, and then come back. Okay. First problem talks about David Richardson and his incorporated painting business. Okay, and it gives you a number of transactions and asks you to prepare an income statement. So again, an income statement. We've got our revenues, okay, and this is assuming we're on the accrual basis, all right? So again, cash basis would be when we actually receive the money. Accrual basis is when it's earned, okay? We've got expenses, and those are expenses when we incur them, even though we might not necessarily pay them. And then after that, we've got our net income, okay? Net income, then we can decide what to do. If it's a small business, we might pay it out to shareholders in some type of distribution, okay? And I believe that there's an entry here in one of these two problems about a dividend. Yeah, about the third one to the last on this problem. It says the business paid cash dividends of $1,500. That's going to go after the net income. Okay, so take a look at some of these. And again, the only thing that might trip you up, and well, I guess there's a few things that might trip you up. But the only thing that the big thing that might trip you up is it doesn't matter if we received it in cash or not. Okay, so if we've earned it, if we've done the work, completed the work, we recognize the revenue. Okay, now on the income statement, there's no adjusting entry, no anything else when we receive the cash. Okay, that, believe it or not, is a non-entry, at least on the income statement. Now on the balance sheet, it would go from an accounts receivable that would then convert into cash once we receive that money. Okay, but on the income statement accrual basis, just takes into account revenue when we've earned it, even though we haven't collected it. Okay, so that's one reason why we might show a healthy income statement as a business, but we might be, the term is cash poor. Okay, so keep that in mind as well. So we're going to look through these. You know what? I'm trying to think if there's any that jump out at me that might be a little difficult. I don't think so. DR paid and received cash of $40,000 from David Richardson and issued common stock to David. Okay, that means we're going to have common stock. That's going to be capital paid in. Okay. David paid. Look at the bottom there. I'm just kind of glancing through this. David paid $100 cash for personal groceries. Okay, personal. All right, so this wants to throw you off a little bit. I think it's pretty easy though. Personal means it's not a business expense. A couple other things. Let's see here. We've got, say, business purchase supplies costing $1,800 on account. Okay, so that means that we bought those, and if we're not going to depreciate it, which we won't with supplies, we recognize that as an expense. Now, keep in mind, then they pay $800 cash toward that account. Okay, but they've already recognized the $1,800 as an expense. So there's actually nothing else you would do with the $800 cash transaction because it's already been recognized as part of the $1,800, even though we haven't paid it out in cash. Okay. So again, you're going to have revenues, we're going to have expenses, and we're going to have our net income then afterwards. And then after we have net income, okay, then we decide, okay, what do we do with this? All right. So that first transaction, think about whether it needs to even be on the income statement. Okay. Let's move on to problem 2. And again, this is the income statement assignment. Elegant arrangements. We're talking about a floral company. We're going to prepare an income statement for them. And this is pretty straightforward, revenues and expenses, okay? But where it gets a little, not tricky, but where you have to analyze the data is, look at number 2. Evaluate the results of 2012 operations for Ellicott arrangements. Was the year good or bad? Well, did they make money? Did they not make money? And what was the reason why? Okay. And then they say, well, what happens if income was 20% less? What happens if salaries are 20% more? Okay, so just multiply both of those entries by that 20%, and then look at the look at how that affects the business. The easiest way to do that is through an Excel spreadsheet. Highly recommend that you use that. Number 5 then talks about depreciation. Okay, depreciation is a non-cash expense. It sounds a little bit like an oxymoron, but basically, if I've made $5,000, okay, but I bought an asset, say, worth $10,000, okay, I can, with a 10-year useful life, I can take off, okay, I've got 2 options. One is I can take the whole expense right now, okay, $10,000, okay, or I can take off $1,000 each year, $10,000, 10-year useful life, okay, that is $1,000 a year, okay, and we're kind of getting into the depreciation assignment too, where we talk about Warren Buffett talks about depreciation, saying it's not that great of a deal, and he's a lot smarter than I am, so I'll definitely cede to him. Okay, so here's the thing, depreciation, we say, we've got the option again, we can expense this, okay, take the whole expense right now when we buy it, okay, but if it's something big, if it's big equipment, say 6 or 7 figures, $1 million, that might show a really big loss on our income statement, okay, which is okay, but if we finance that transaction, maybe we don't want to take that whole loss. Okay, maybe there are tax ramifications. Say, if we show a loss of $700,000, we might not be able to claim that. Okay, but if I spread that out over 10 years, maybe I show a small gain for each of those 10 years, and I can save on my taxes. Okay, where depreciation, where somebody says, "Ooh, look at all that potential depreciation." If I'm looking to buy a company, okay, so let's say I'm looking to buy Olivet Nazarene University. Okay, it won't happen. But let's say I'm going to buy Olivet Nazarene University and potentially maybe turn it into a for-profit school. Okay, if I were to do that, which I'm not. Okay, I would say look at all those new buildings. One, it's great that I've got those new buildings. Okay, because they're a great asset for students. But also, I would say, as a for-profit institute now, or institution, I would say, look, I've got all those depreciable assets. So if I've got that new recreation center that costs maybe $35 million to complete, I would say, boy, for the next 30 years or 35 years, I could take $1 million of depreciation. Okay, even though I haven't paid for the building, if I buy the university, I can depreciate those assets. Okay, and when I depreciate those assets, I get to basically shelter income. So if I've made $2 million and I take $1 million worth of depreciation, now my net income is just $1 million. Okay, which is fantastic because I only then pay taxes on the $1 million, not the $2 million, even though I might have more cash on hand than I do than that $1 million. Okay, so your assignment then for this is, given this statement that Warren Buffett made, why do businesses look favorably on non-cash expenses such as depreciation? Well, that might be part of your answer, but definitely do some more research to see why exactly might be some other reasons. Okay, and here's our plan. So for week 3, we're talking about the income statement and depreciation. Week 4, we talk about balance sheet, and that talks about what assets I have at a certain point in time, what liabilities I have at that point in time, and then hopefully there's a surplus of assets, more assets than liabilities, and that's ownership equity. Okay. Here's where we're going though. What we're going to start looking at is making sure that the cash situation of a company and the profit situation of a company, that we understand why sometimes those aren't the same thing. Okay, why can you have a company that's showing a profit, okay, on its income statement, but it might not have a lot of cash on hand, okay, or they might be cash poor, they might not be able to pursue opportunities because they don't have enough cash on hand. So think of it as, from a personal standpoint, think of it as, okay, I've got a nice house, I've got nice cars in the garage, but I don't have much cash on hand. So a company, so in a personal side, you might say, well, that person or that family has too much debt. Okay. On the business side, you might say, well, gosh, this company looks to be doing fine. They have a lot of income. Okay, but they don't have a lot of cash. Okay, there's a few reasons that could happen. We'll get into those in detail soon, but some of those are, one, they might not have collected on their revenue, so they might have all those receivables out, but they might not be able to collect. And when the economy goes bad, like it did in 2008, 2009, that becomes an issue. Okay. The other thing might be that they might be taking a lot of depreciation, or they might have used a lot of money up front, cash up front, to buy big ticket assets, like a manufacturing plant, like say a fleet of company cars, things like that. Okay, so if they've depleted their cash, that maybe wasn't the best financing decision. Maybe they should have leased those vehicles or that equipment, or they could have even financed. Okay, it depends. Sometimes it's good to buy in cash for a company. So Apple and Microsoft, we might say, gosh, you've got too much cash on hand. Okay, other companies, we might say, you don't have enough cash on hand. Okay, there are a host of other reasons, and when we get into especially the Hampton Machine Tool Company, I believe that's week 4. You'll get to see, like, gosh, this company should be doing fine, but in all actuality is really struggling with their cash flows. Okay, so that's very important, determining how a company looks financially on paper and how its cash flow is. Okay, that gets back to week 1. Cash is king. Okay, and it'll be really interesting when we get a chance to look at especially Enron a little bit. And I think we'll at least touch on that during this week. So that's it for that's your 12 minutes and 40 odd seconds of my wisdom or lack thereof. If you have questions, shoot me an email or give me a phone call. Looking forward to catching you guys in the discussion boards, and I hope this helps with your assignment. Don't forget to post to the discussion board by Wednesday evening. This is Tuesday evening, so have a great week, and I will talk to you soon.